All right. Well, welcome to Page Trader. David Williams is with us today.
Thank you,
And
Saul.
you are here at PitIQ.tv, and Page Trader with David Williams is going to give us his take on a couple of these markets that we are looking at. Obviously, the last few days, last few weeks, market has been exceptionally slow, and it's been testing our patience, I think, at least at this end in Chicago. And we are all on the verge of FOMC release of their announcement on interest rates in about an hour or so. So we'll see where that is. So we're going to give each other's ideas here on what the market might be trying to do, or maybe will do, over the next couple weeks here into the summer. And we'll see if we can share ideas, and maybe we can help somebody out there with a position or some thought of a nice trade that they could put on.
Anybody who wants to ask a question, isn't this correct, Saul? They can type it right into your GoToWebinar text box.
Absolutely, yes. I think both of us love to see questions, because I think we both like to make sure that our audience is on the same page as we are. And yes, if they seem to stray, we would love to correct you and be able to converse with you. So the only way you can let us know that if you're on the right page is make sure you ask questions, because that's the only way we'll be able to understand what's going on. There we go. There's one of them. Where are we going today? He doesn't hesitate.
Right out of the box. Well, listen, it's a great question. The problem with that question today is that because we do have the Fed interest rate announcement, and it is such a widely, the market pauses for that announcement. That's what we're seeing here. That's what the slowness is that we're seeing right now. It's basically at a standstill. And for practical trading purposes, at least this is my answer, and I know Saul will have his own take on it, but my particular outlook is that on Fed interest rate days, I try to not be in the market probably 10 minutes, 15 minutes before, and maybe as much as 30 minutes after the announcement. I'm not trying to trade the announcement per se, but as I was speaking with Saul earlier, we were both agreeing that the markets tend to have a multi-day directional move after even very soft Fed announcements, soft meaning not a big initial response. And those are the moves that we tend to trade more. There can be a lot of volatility in the announcement if there's any kind of surprise. And so what I try to do is I try to do, your question is a valid question, but I try to answer it after the Fed announcement, usually not before. So
yeah, I've learned through personal pain for me not to trade the FOMC announcements at all.
Right.
Personal pain meaning that I've been in the pit, and I've the volatility is just so great, and I mean, especially if they say something goofy, and we don't have a chance. You don't have a chance. As soon as you think the direction is set, they reverse it, and it's reversed so fast in your face that traders just don't have it. Even in the pit, when we didn't have a chance, when they decided to reverse, because you're not thinking, oh, what is happening? And so my suggestion to my group of people is that we just, there's always going to be trade tomorrow, like you said.
That's right.
It's going to be a directional trade. You expect that for the next couple of weeks that we'll have some kind of trade based off of the statements that they make, or any kind of actions that they may take. So consequently, we don't have to trade today. If it's something, if the volatility is too great. But there's a lot of tea leavers out there who are trying to understand, or trying to guess what one word means, and what a syllable means, or a comma in the wrong place means. And you know what? They'll figure it out tonight, and they'll start at it tomorrow, and we'll be able to get ready with a full tank of gas going at it tomorrow. So like you said, you stay off for half an hour, half an hour after. I just stay off completely. So
yeah, no, there's nothing. Not only is there nothing wrong with that, but one of the skills of a trader is to know when he is guessing and when he's acting from authentic high probability, and the difference is night and day. And I'm very comfortable telling you that I don't want to be in the mode of guessing. I don't want to guess. I want to be in when I know the probabilities are very high in my favor. That's the skill of technical analysis, is to know where and when your edge can be asserted.
Right. I
And
mean, that's what we're trying to do here. We're trying to figure out the quote unquote
absolutely.
edge, right? That's what we're trying to find. And the edge doesn't necessarily mean you're going to be right away, but the edge means that as long as you find a trade based on your logic that you have, know works in the past, then you're fairly confident with putting on the trade and giving it a shot. But otherwise, on these days when the market just kind of swings around, again, I don't see much swinging around today, but then I'm always wrong about these things. But last time when they raised, it didn't do anything. It just was dead. I was so surprised. But now I don't trade it, but I'm here watching it. So let's.
Yeah. Well, you don't have to trade it to glean information that you will then trade later. As you well know, your act of not trading doesn't mean completely non-participation. The fact that you're watching it and gleaning the information means that you're going to put it all together, not in that moment maybe, but in the next day's session, like you said. And so watching it itself is important, checking the levels and so on. Like as an example, I'll give you an example. So in our work, normally today, by the second 2-hour completion, if you think of an hourly bar, and then you have a 2-hour bar. And so the second 2-hour bar's completion, we normally would be down testing 2472. This is just the nature of our work. It's related to time. So so our normal trade, if it wasn't for the Fed announcement and the really super narrow 3-point range, 4-point range that we have, we would normally have shorted the market. Instead, we're flat. We would have normally shorted the market for a trade down to 72, which is a number that we had forecast yesterday into today. And indeed, the Globex low was 72, but we don't trade Globex per se. We trade the pit session. So, and I think the same thing for you, Saul. So we would normally be doing that, but we're not doing it today. Even if they do get down to 72, we're just not going to put ourselves in and have to wait for the Fed announcement, and possibly have to wait for the Fed announcement to even get the 72. And then it gets faster and more difficult to trade and so on. There's plenty, like Saul said, there's going to be plenty of gas in the tank tomorrow and the day after. And I believe, as I said earlier, we'll see a multi-day directional move off this. And we'll trade it correctly. The market really is in a very strong position overall. And I don't know if I've mentioned this, Saul, before, but our take on the larger picture, and by that I mean the yearly outlook for the S&P, is that in spite of the usual declines that would happen in any larger trending market that's trending up, we believe the market still will head higher into 2020 plus or minus a year. So I know those are really big time frames, really big units of time, but that means that in our work, we believe that the market's going to remain in a trend with the usual downtrends happening, the pullbacks, but we're going to be in an uptrend into at least 2019. So that's our bias on the big picture. And I think it's important to have some scale to your trading. That means that you are interested in and have a mental picture of your larger outlook, and then you sequence it down, just like Saul has his various time frames of charts there, that you learn to think in multiple time frames rather than just in one, because you don't want to be the smallest force in a room of larger forces. And if you are the smallest force, meaning that maybe you're trading on an extremely small time frame, you want to have some understanding of what those larger time frames are doing. You don't want to be blind to them, right? We don't want to be completely ignorant of what the larger time frames are doing. I just extend that out even to the yearly, because it helps us sell option premium and things like that, something that's another angle that we take on the markets. And I don't know, Saul, if you do any of that.
No, that's true. I mean, you definitely have to give yourself, I think every chart that you look at will give you a little bit different feel for the market, whether you're a short-term player or a longer-term player.
Right.
So there's no reason. Look, we don't. We're scalpers here, so we're not looking to take anything overnight or even longer term. But the longer-term charts give you levels that you don't see, in a short term, especially these days. But in case something breaks out, in case the market does break out of an area or a pattern or a set value area, then we can at least find those areas for us to trade.
Yeah.
I found it that it's very important to give yourself different views. Like that's why I think it's great that we talk to you, because I think it gives us a little different take on the market, gives me a little different view to look at, and I feel that it's good that we share, and I think that's why a lot of the people that follow us, because they want to listen to different ideas and different concepts, and I think that's the more you open yourself to different ideas and concepts, I think you'll become a better trader. So that's that's what we're here for.
I totally agree. And the one thing I would say also is that if you're going to listen to somebody and listen to different ideas, make sure that at the very least that you have a way of vetting some of that, because there's a lot of bad ideas, and I hope that we're not giving any of those out. I don't think we are. But there's a lot of bad ideas, as there are a lot of good ideas in the markets. Here's a bad idea: holding on to positions because the market always comes back. That's a bad idea. I mean, that's one of the worst ideas. I'm going to the Adolf Hitler level of bad ideas in the markets. A lot of people tend to think that, well, listen, if the market's going to come back, which I think the market's always going to come back, this is what a person thinks to himself, a trader that has this bad habit. He thinks the market's going to come back, so why should I take a loss if the market's going to come back? And indeed, the market does come back in the majority of instances to a range and so on. There's many problems with that, though. And the main one is that there's going to be a time when the market leaves an area for a long, long period of time. And if it's going to leave it for a long period of time, it's going to be moving away in a long, distant price. And that's where you get wiped out. Terrible set of words, but you do, by holding on to losing positions until the market comes back. You do have to have, there's nothing wrong with having a losing position on, but you have to have a place that you say, if it gets to this number, it actually is going to be wrong and I have to get out. And in many cases, it's going to come back. But if you let the market train you to do that, you will ultimately, it's not a matter of opinion. The market is going to leave an area and stay away for as long as years, and you won't be able to tolerate that. So it's not a good habit. That's a good idea. That's a good example of a bad idea.
Well, my thought about that is simple. I think that if you hold on to something and it's a bad trade, and you're saying years, I mean, I think it's like at some point you're going to get a call and say, hey, buddy, what are you doing? Anyway, but my take on it is this. You keep onto a position that you think is going to come back, then you take yourself out of the ability to see other opportunities.
That's beautiful.
To take trades that will be working for you, and because you're stuck on one situation or one trade. So instead of being stuck with that one trade, get out of it. You're going to miss a lot more opportunities waiting for that thing to come back to scratch than you would if you actually traded and made loss, because at the end of the day, you're going to make money while you're holding it in one trade.
That's right.
Scratch.
And Saul, and I'm sorry to interrupt, but I was going to say, most people, even if they are holding on to a position, by the time it's, made them wait a long time, all they're really trying to do is pray to the baby Jesus to get a break even. So they're not only are they not making money like you're saying, they're actually hoping just to be able to get out at even, and they've wasted all that time, right? And there's nothing in it there. So you'd be wiser getting in and out, and trading, which is what this is all about, and getting ahead in that same period of time rather than holding for a break.
That's the misconception that most people have, is like, you're not gonna, if you're gonna, let's say for example, if you got a 10 or 12 point loss on an ES trade and you're gonna hold on to it, you are not going to wait till you make a 10 or 12 point profit on it. You're going to be thrilled that you got back to even, and then in that interim, you missed all that opportunity there to make, let's say 3 or 4 points, because you're holding on to the one, and you're scratching it. So, that's that is some of the things that new traders don't realize. And and that's why we always say that you need your stops in there, because you got to look for the next trade. You can't be worried about the last one.
No, that's right. One other idea that is what I think is a right idea that you have to expect is that the market, and I know you know this, Saul, but the market, part of the built into the market is the fact that it's going to test your resolve. It's going to test your confidence in what it is that you think the market's going to do. So as an example, when you put a trade on, we've all had trades that go immediately in our direction, but in the majority of cases, you're going to have to sit through some kind of test, and that test is the market testing the resolve of traders at that particular level. And so you have to go in expecting to be tested. Your resolve is going to be tested. And this is why it's very important that before you get in, you actually do have a resolve. You do have a very good idea of what's likely going to happen. You're even enthusiastic about getting in to trade that. And that enthusiasm will help you to sit through the test of your resolve. I mean, just as, if I may, just to show this, here's a trade that we took the other day in crude oil from 47.70. We did get a near immediate move up on a 30-minute chart to 47.92, but we had to sit through a test of our resolve right here before they paid, before they got to where we actually thought they were going to go. And that test is really common. No matter where you seem to enter the market, they're going to test your resolve. So don't flirt around with the market. Be in it for a very sound reason that you understand and that you're enthusiastic to be in, because it's very likely that your resolve is going to be tested. If you don't have that resolve, that enthusiasm, you're going to jump right out of the market and you'll have a series of small flush outs, if you will, and you'll feel frustrated by that. So one of the things I've learned, and I know Saul has learned this, and you can comment on it, Saul, is that you have to know what you're doing and you have to have enthusiasm to do it, so that when your resolve is tested, you sit through that and you're in for the move that you really expected. Would you agree, or what's your comment on that?
Yeah, absolutely. What we try to do here is we try to teach each trader to take the risk out of the market by putting in a stop. If you put your stop in, which you're calling your resolve, you're not. We don't want you to think about the trade anymore, because you know where your loss is and you know where your targets are for profits. And as long as we know where our losses are, then we can manage the trade accordingly. As long as if the market goes our way, you can have adjust your stop accordingly. I have a trailing stop. If it just sits there and doesn't do anything, but you have your stop in, but all your logical reasons for entering the trade are sound, and you feel comfortable with the position, then you got to just, like you said, go through the pain. The market is always going to give you pain before it gives you profit. And the pain sometimes is hard to swallow, but as long as you put your stop in, as long as you know how much money you're going to lose, and if it's consistent with all your other trading patterns that you have in regards to profit and loss, then we try to take that itch to go in there and do something, because you feel like you have to out of the market. And that's the thing that like you said, it hurts a lot of new traders, because they don't realize that the market is doing that because they want you to get out. I mean, they are just like, they want you to get out. But you went in for all the logical reasons that you know these trades work. You've seen it work in the past. And you just got to be patient and let it play itself out. Because, like you said, the reason the market went up in your example was because they had that push to the downside. They got everybody short because they thought it was going to be a breakout, which I think what you were looking at, and they didn't get it right away. So the sellers came in there, sold it a little, but then the buyers came back because that level that you're talking about held, and all of a sudden they got themselves short. And the reason that it popped was all those guys who got themselves short had to run out to the exit and gave you the opportunity to make money. So my thing is that sometimes if you're looking for the market to go up, it has to go down first. Get everybody caught short, and then pop the thing up, and you're like sitting pretty as you're waiting for your target to get filled.
Yeah, I'm not in the market. Saul is not in the market for comfort. We're not looking for the market to give us comfort. What we're looking for is a trade that has a high probability to be correct. Comfort is not what you should be looking for from the market. If traders out there are thinking about that, the market constantly tests you. In fact, it can drive people crazy. And I've had clients from our business say things to me like, I can pick a top in the market just by going long, because as soon as I go long, the market's going to turn right then and there. And that's how I pick it. I just have to put money on the line and it'll stop. And after a while, you've driven yourself crazy to the point where you think that the market really cares about your position, and it really doesn't care. It's just the nature of the whole thing that by the time you've entered, others have entered, it's going to test that area, and you and I and everyone have to just have the courage of our convictions and be willing to have our resolve tested on the way to having a thing. I mean, look at the center trade here. We're talking about shorting the market here. They first had to go against us before hitting the 72 on the overnight. Look at the bonds over here. Bonds should continue to advance to 154.25. Well, we had to sit through a decline to 153.30 before we got the run to 154.25, which they completed over here. It's just the nature of the market. Obviously, by looking at these charts and Saul's charts, it becomes very obvious that a skill is to know where to place your stop. That is another part of this whole equation that, and Saul, I don't know, I haven't asked you this before, whether you use a dollar amount stop or a positional stop, a strategic market position stop. I happen to, for me, everyone trades differently. I happen to not like the dollar stop because a dollar stop is an arbitrary thing. If a person says to me, and I want to hear from you, Saul, if a person says, well, listen, I don't want to ever lose more than, say, $200 on a trade, well, by placing a stop at a $200 level, that very well may not be at a place where the market would have difficulty getting to, or nor that it wouldn't normally trade to. So I don't want to place an arbitrary stop based on what I'm comfortable winning or losing. I want to place a stop where the market shouldn't be able to go if my trade and my convictions are correct. And I try to locate that spot in advance, and that's the stop that I'm going to use. And I will ultimately move it up. What about you, Saul? How do you think about stops, or whatever you'd like to throw in on that?
Right. Yeah, I agree completely with what you just said. And what I try to do is we have a 2-point stop on our ES, but my exit strategy is where you're saying that you don't want to be long anymore.
Right.
Or short.
Exactly.
So I kind of go at it backwards. I find that area first, right? Then I say, okay, is it a support or resistance level if I put my buy or sell against that level, right? And if it fits with the support level that I see, and I know I don't want to be short or long above or below that area, then that'll be my support level that I have based on what you're saying as far as you don't want to be long or short beyond a level. And what I'm saying, that the level is a good support or resistance level based on technicals. So I try to combine what you're saying with my support area. And that way I feel comfortable in saying, okay, we're going to have a $100 stop because it's a 2-point stop. But again, at this point, I don't want to be long or short above or below this area anyway, so I'm comfortable with my stop.
It's a dual, it serves two purposes, and it works out effectively the same as what you're saying.
Now, right. I mean, you're going to have, like what I like to try to find is an area where I have support followed by that area where you get out, but then there's another support level right underneath it where I'm thinking, okay, I can middle it kind of, and try to see, once we really get below that second level, then I really don't want to be long or short, below or above that level. So that you're right. I go back. I do exactly what you're saying, but I look and try to find those levels based on that scenario where I don't want to be long or short anymore. Now, if the market goes your way, like you say, you adjust it, then I'm using what the market is telling me, the price action at that point, to say, all right, well, I don't want to be short and long anymore, but I'm going to adjust it because the price action is telling me that I have to adjust it at that point. I don't want to have my winner now turn into a loser because that's stupid, especially since I got in at the right level, and I'm just going to work it from there. So
sure. It's kind of like a detective story where we're getting new information as the story unfolds, and we're adjusting our actions according to that. And that's part of the skill of trading. One last thought I was going to express, Saul, if we have another minute here. I don't know if we do, but
yeah, we do. We've got 5 more minutes.
We've all played Marco Polo or something like that in pool. I'm 60. I don't know if maybe the younger people don't know that game, but that's where you're in the pool and everybody's, you're blindfolded or you close your eyes and you try to catch somebody else and you have to yell Marco and they have to yell Polo. So let's picture a pool with a bunch of people swimming in it.
This is the first time that I've ever heard this analogy in trading, but go ahead.
Well, I want to be a first for you on some level here. So anyway, so let's say there's 5 people in the pool trading, and they're all splashing around. That's fair enough. And there's a guy over there at the end of the pool, and he's jumping in the pool. He's jumping off the diving board. And he's making a big splash. All of that is like fundamental news and things. That's the analogy happening. There's new events happening, producing waves in the pool. But let's also say now that everybody gets up and leaves the pool, all to go out on the patio there and have a picnic. Now, the pool is still operative. The pool still has waves in it. And those waves are the residual energy from all the people that were splashing around in it. In our particular work, we really like when after news comes out, like this thing that we're talking about, Saul, with the Fed announcement today, in just 30, 40 minutes from now, that's like somebody jumping in the pool. That's people splashing around, creating new energy in the pool. I'd like to be out of the pool when that happens, but when everyone leaves the pool, when all the news is kind of over, the pool is interacting with itself, essentially. Those waves are banging into each other without any new real energy coming in. To me, those are the periods where I can do the highest probability of forecasting, because I'm working off of what you could think of as residual energy in a swimming pool rather than new energy of all the people splashing. They've all left the pool, but the pool is still interacting with itself. It still has a lot of wave action, and that is very easy to work with as a trader. And that's another reason why, as an analogy, I like to be out of the pool prior to and slightly after the initial impact of Fed announcements, particularly important announcements like Fed announcements. So there you are. I hope that's new information.
Well, you know what? I appreciate your understanding of the climate around us these days. It's summertime. You're thinking pool.
I am.
You're bringing it back to work. That's why you're so good. I mean, this is why. Who would think of putting it that way except for you? Because you're probably sitting by the pool right now, waiting for something to happen.
you found me out, because I'm in Las Vegas and it's hot out here, and I wish I was in the swimming pool. No, we'll see. Let's see how today plays out. Patience is a virtue.
Quickly. What direction are you looking at? Obviously, you said you're bullish longer term.
Yes.
But shorter term.
For today, I said,
let's say a couple weeks.
Oh, well, generally we're bullish. I think we're bullish longer term.
Buying dips.
We are buying dips. That is correct. And we, as I said before, for today, normally we would have already been trading down to the 70, a test or attempt at 72. But I am, Saul, generally bullish, even with the pullbacks and so on. I'm generally bullish right now. And, we specialize in forecasting, and that's how we approach the market. Everybody is making a forecast, even if they don't think of themselves as forecasting, because even if you're trading for very small gains, you're still forecasting that something like that move is going to happen. Just be sure that you know your methodology. And for those of you that are new and haven't heard perhaps Saul or myself, or only heard one of us in the past, it's very important to find somebody who knows the hell what they're talking about. And there's less of those than you think. And without sounding too blunt, I just want to state it for the record that I happen to know that Saul knows what he's talking about. I followed his work. I hope he believes the same of me. I think so. And that there's a lot of value here in listening to people that know what they're talking about and acting upon that. There's a lot of people that can tell you a lot of things. There's millions of ways to trade without being profitable. But to do well in the markets takes a number of skills blended together. Just like riding a bike, it requires steering, balance, forward motion. All those things have to come together to do it right. And with practice, anybody can do this. That's the one thing. It doesn't require any special guru. But you don't want to be sent off on the wrong path for 5 years, do you? So I like coming here because I know we're giving good, real information to people who are really making honest efforts to improve their trading. And Saul, as always, I want to thank you so much for having us on. I appreciate it every time, and I really enjoy your wisdom as well.
Absolutely. And just by the by, I've got 72 also. I've been waiting for 72. I've been waiting for 72 all day.
Well,
and of course, another 20 more minutes, and I'll be.
We'll see. If we can get down there. It's just that it's a Fed day, and that's why we didn't want to trade.
Right. No,
So,
but I do have 72, and I think I like 61 down below. If you really must know, that's my level that
okay.
I'm looking at for the last couple a week or so. But I just
Well,
thought we would get down there. It's just
yeah,
not moving.
we haven't been able to do it yet. And I'll tell you, I don't know when the next time I'm on is, but we'll check. Well, let's see how things play out between now and then. And I always enjoy being here, Saul. I thank you, and I hope to see
Absolutely.
you
Well,
guys soon again.
thank you. This is PitIQ.tv along with David Williams from PageTrader.com. I appreciate you guys joining us today, and please visit both our websites. And I hope to talk to you soon, David.
Thank you, Saul. Have a great day here, and see you guys all next time.
Okay. Take care. You too.